there is a shadow economy that there's only one way to participate in. When you think about the Mag 7, all of them were hugely successful private companies before they went public.
Yep.
Yep.
And it's happening even more now than ever. There is an entire trillions of dollars in wealth being created before the companies even go public, where they've
Yep.
grown 100x in value. Again, that happens rarely, but it happens. Some of them, of course, fail. That's why they have a portfolio of them. But so much wealth is being created right now, and these funds keep getting bigger and bigger, which means that they do what's called a sponsor-to-sponsor transaction. One private equity firm sells to another private equity, where they do another round at a higher price. And we're seeing it right now with Elon Musk's other ventures, like massive, almost trillion-dollar valuations for companies that are not even investable yet for the public markets. By the time they come, they've already had this massive appreciation. They're already quite expensive. So I think that's the other thing is the world has now gotten so much into alternative investments that you're missing out on a major asset class. And technology has allowed us all to get access in different ways. So that's really exciting. Hello, everybody. And as you can tell, Terry is not here today. Unfortunately, I'm hosting duties. I will do my best. And our goal, as always, is to not just entertain you, but hopefully educate you and help you make better decisions, not just about investing, but financial planning too. As you know, I'm a CFA, a Chartered Financial Analyst, and the Chief Investment Officer at Rise Growth. I was a partner at Goldman Sachs. I built one of the largest RIs in the country prior to that, actually two of them, and have been an entrepreneur my whole life. And I'm really thrilled today to have with me Scott Schwartz to provide the CFP perspective. Scott, you're a senior partner at a $10 billion Bleakley Financial, where you do not just planning, but great investing advice. So we're thrilled to have you here. And we're really happy to the head of research and alternative investments at Bleakley, Alexis. I think this is your first time here. I know you're going to bring us brilliant insights, and we're just thrilled to have you here. So thank you, both of you, for joining us. I know we're going to miss Terry a lot. She sent me a picture of her and her daughter looking at whales in Hawaii. So I guess she's having a great time and hopefully having a Mai Tai. I know she likes them occasionally. So it's great to be here. Hey, it was nice to have a sort of mellow week this week. Let's do a quick recap. Obviously, volatility, we were all a little concerned it was going to get very volatile next week or this week. Turned out to be not so bad. And we had still 1% swings every day, but nothing hectic, slightly positive. We had one bad day, a couple of good days, and today relatively flat. All led a lot by the Fed. So why don't we just talk a little bit? By the way, interest rates dropped a little down to 4.2 on the 10-year. We're actually below 4% on the 2-year. That's the first time in a while. The pricing in some of the rate cuts that are going to be coming along the year. But obviously the Fed was the big news this week. And I frankly was a little bit surprised at the frequency that he used the word uncertainty. That seemed to be the word of his speech. And I think he was I'm not sure, Scott, but I think he was patting his back a little bit about, hey, I did my job. We brought down inflation and the economy is stable. But don't count on me. I don't know what's happening next. That's the kind of the read I got is I did my thing. And Scott, what did you take away from the Fed's speech on, I guess, yesterday?
I don't disagree. Lots of people talk about the Fed. People talk about charts and blots and a lot of things. I get all that. From our perspective, we think they have some control, certainly on the short end. When you start to get out to the middle or longer end of the curve, I think the market has a lot more to do with it than they do. Again, it looks like they'll probably reduce rates once or twice this year, assuming that things stay on schedule. Not a huge, change from our perspective. We're still going to continue to do what we do. We're going to pay much more attention to our clients' time horizons, risk tolerance, cash flow needs, et cetera, than we are to, Powell. But yeah, I thought I would concur with your thoughts on that.
Alexis, I think we're seeing some anecdotal evidence of maybe a slowdown in the economy, but not enough to suggest that we know whether it's actually slowing down or not. but I'm struck by Powell's uncertainty. I mean, it doesn't feel good when the head of the Fed doesn't really know what to expect. And he was clearly hedging his bets based on what might happen with tariffs and the government reduction in spending. How do you think he came across? What do you think is? How do you think he's framing himself? And it seemed like he was like, "Hey, we can drop rates if we need to. We can increase rates if we want to." What did you take away from his speech?
Yeah, I mean, I think we all are feeling the uncertainty in the market, and I'm sure the Fed is as well, where they're trying to control, not getting too far ahead of themselves by cutting too soon. Obviously, that can, lead to a blowback in the wrong direction, but not getting too far ahead of themselves on the other end of it as well. So I think I don't blame the Fed for being uncertain, and I think there's a lot of, economic data points that are looking better and the economy is looking fine, but just trying to find that balance between the growth and the potential inflationary impacts of tariffs if they do end up coming about.
And we of course have to remember we've priced in a 10% drop already, right? And NASDAQ even more than that. So it's already priced in some level of slowdown. But Scott, one of the stories I read this week that I think is worth talking about is the idea that people are now building up cash. Big outflows from equity funds this last week. People going more to cash. There's already $9 trillion on the sidelines. And so you're dealing with people every day. How do you think about it? What when somebody calls you and says, "Okay, it's time. I'm taking my retirement money. I'm moving it to cash. I don't want to go down anymore. I'm retired. I can't afford losses." What's your advice? You're a financial planner. You do this every day. Are you seeing that from your clients? And if not, it's still happening generally. What would you advise people who are afraid and want to seek some cover?
I think the most common question that most financial advisors have probably gotten in the last 2 weeks is probably, what do we do now? And I've got two thoughts on this really. One is, really, guys, nothing's happened yet. We are talking about being down 8 to 10 from the all-time highs. So, our, clients' portfolios are positive on the year. So as they're watching TV and not really looking at their statements, I think most people out there right now have this feeling that things are worse than they actually are. So that's one thing. Makes people emotional. So as people are calling me and saying, what are we going to do about all this, right? Well, the real answer is nothing, right? This isn't the time to do something. The time to do something was last year, right? In anticipation of this, paring back equities at the top of the market, paying much more careful attention to what your cash flow needs are going to be for the next 12, 24, in our case, with retired clients, 60 months. If I know where my client's income need is going to come from 60 months because we've laddered out a bond portfolio, we understand our dividends, we understand our income. Well, I'm not worried about selling stocks because I think that the market might come down a little bit. I'm going to be a buyer of stocks if they come down anymore. So again, it gets back to the plan. I don't think being a reactionary in a market like this makes sense, Joe. To your point, no, it's not time to sell. It's time to hold on. You own quality stuff if you're positioned correctly. And if things get really bad, that's when it's time to buy. That's our take. That's how
I guess if you're asking the question, should I sell after a decline, it's already too late, right? Like stocks are already on sale. You shouldn't be, it's not like you go, "Oh, I should buy cars after they've increased in price." You do the exact opposite in your regular life. I would say, just interestingly, when you look, Alexis, at people who are investing for 10 years, look, the media does a great job creating content that makes everyone excited, and fear is the strongest seller of all. So I've done a thousand, I don't even know how many appearances on CNBC and Bloomberg and all the rest. And it's always about creating urgency right now. Here's the stocks you should do. And what should you do with Tesla right now? When in fact, stocks are really anticipate the future, already price in the future. So if you believe that the markets are efficient, which I absolutely do, and no one has shown me any evidence that they're not, you can't, the market already reflects what everybody already thinks about the future. So Alexis, if somebody has a 10-year before they need that money, and obviously if you've got 3 years, that's a different answer, right? Like you should not own too much in stocks if you're a 3-year time horizon. But if you have 10 years to go, there's very few windows where you're going to lose money, right? Like how should people think about that?
Yeah, I think that's exactly right. I think the liquidity piece is always, what we try to solve for here at Bleakley, depending on going back to the plan. If you're nearing retirement, you probably shouldn't have a larger exposure to equities, and your allocation really should meet the plan. But I think on the other side of it as well, something to really keep in mind is the power of staying invested and to not be reactionary, because if you're trying to sell at the wrong time and you're trying to sell when, there's a pullback in the markets, there's plenty of data to show, if you were to stay invested over that 10-year period or the 20-year period and did not take your money out, even when there was 20-30% pullbacks, you still wind up much further ahead rather than, trying to time the market and pulling money out and then trying to time it, putting it back in. To your point, the markets are efficient and we go through cycles. That is part of, the reality that we live in. And as long as you're allocated properly, as long as the portfolio matches the plan, we typically like to hold tight and not be, as reactionary.
Hey, Scott, I know in one of the earlier shows, I remember you saying that you had people calling going, I want to own the Mag 7. Like, I got to own the Magnificent 7. Like, they're all happening now. Are they calling you and thanking you for having them diversified or not? Or is that a silly question?
I had a client that I was reviewing with on Monday. He had an experience working at Microsoft for years, so had a very large position, very highly appreciated. He's a fairly new client. We've been working with this family for about 18 months. In 2023, we sold off some Microsoft. We tried to straddle the 2 tax years to spread out the capital gains. We sold a pretty good chunk between 23 and 24, reallocated those assets. So as we were starting to have our conversation, they're very nervous about the markets. This is a week ago now, before the market kind of came back a little bit. The conversation was, hey, we've reduced that position. We've missed a lot of the downside. We're still positive, believe it or not. They were very happy to hear that. And I said something like, hey, listen, I'm not saying I'm Karnak, but, and I'm not. But at the end of the day, it was an obvious planning move. You're overexposed to something. It's at a very high level. The responsible thing to do is pare it back, pay some taxes. That's okay. When we finished the conversation, they just said to me, well, Sally and I think you really are Karnak.
Oh, that's very nice. Right. Hey, good for you.
Again,
let me think. Right. I think it was... Hey, so one thing, obviously, you said 2 things that I think are quite important for everyone watching this. That when you're trading, when you're getting in and out, you're creating tax implications for yourself. And the tax tail should not wag the investment dog, 100%. But it does matter. And the thought of just staggering. Now, you're still, all you're doing is deferring taxes, but it's very nice to defer them for a year. And today you're getting 4% on the money for the year deferred. So it is important thinking about the timing. You'd made a second point that I think is very important, concentration risk. Like, that if you work at a company, you probably have a lot of that company's stock. Right. And if you're invested in indexes, making sure you don't overweight. If you're a consumer staples company or at an ExxonMobil, you don't overweight that sector. Hey, Alexis, we're also seeing something we haven't seen for years. At Goldman, they were always very vocal about U.S. preeminence. And it turned out to be true for year after year after year. We are seeing for the first time, and as far as I mean, it's been years, but the European stocks, they appear to be doing something quite different now, even in China as well, offshore. And I'm wondering what you make of this. We saw this with small caps. They outperformed for a very little while and then reverted back. What do you think's going on in Europe? Is this a lasting thing? I know many US investors really don't get directly into Europe. Now, they all own the S&P 500. They own, by necessity, international earnings, because most S&P 500 companies, at least half their earnings are from overseas. But is this a real thing, what's happening in Germany and other countries?
Yeah, I think absolutely. I think a few things are happening here. The first is, people are looking for places to put money where maybe there's, the reality is happening where tech stocks are not going to go up forever, and people are experiencing that, and are looking for areas to deploy capital and are paying attention to valuations where, when you look at Europe, when you look at Asia, the fundamentals haven't really matched the valuations and the multiples that a lot of these stocks have traded at. And I think you're finally starting to see a rotation as a result of it. Where are the attractive areas of the market? Where do the risk rewards actually look positive? And I think because of the outperformance that we've had in the US markets for a number of years, that can't continue forever. And people are looking for other areas of the market to deploy capital, again, where there's a more positive risk reward picture. And there's a lot of large companies. If you think of Alibaba and Nestle, these are massive companies that are doing similar things to those dominant US players, but for a fraction of the price and a fraction of the volatility.
And you are seeing, I think, a fundamental shift with our US position of US first. It's forcing these European countries to actually spend more on defense, think about stimulating their own economies. So I think you're seeing actually strategies that start to make them feel a little bit more American in nature. Like, let's stimulate our economy because we might be losing trade with the US. And that could create a little bit of a GDP bump in those countries. Again, we don't know what the impacts of tariffs will be. Hey, I want to shift gears here. Our big topic today is why we brought you in more than anything, Alexis, which is to talk about our alternative investments. Gold's been hitting an all-time high. I think that's really the original alternative investment, but we have some questions. And the first one came from Joseph. Hey, Joe, from Kansas City. And he wants to know what is considered an alternative investment. So when people, and they're all the rage right now, what does it mean to say an alternative investment?
Yeah, so alternative investments, are really anything outside of the traditional asset classes like stocks and bonds and mutual funds and ETFs. They're different for a variety of reasons, but I think one of the biggest benefactors of them is to have something that is not correlated to what a traditional 60-40 portfolio looks like.
And let's just take a step back here. Correlated means that typically when the stock market goes up, interest rates behave in a counter way, so they operate differently. Non-correlated means that when the market goes up, this asset class behaves differently.
Exactly.
And we do know, by the way, I think a lot of research has been done on this, that when the S&P falls more than 15%, all correlations start to resemble each other. But give us some examples. Gold is one. Bitcoin, would you consider that an alternative investment?
Absolutely.
And then there's things like private equity, private debt. How are they different?
Yeah, so touching on Bitcoin for a second, although I would consider it, in the alternative asset class, it is somewhat correlated where, not every day looks this way, but it does trade like a risk on asset. So there is some correlation to, the NASDAQ and just broader tech, the tech trade. But it certainly is an alternative investment. But if we, look at the private equity, the private debt,
And just private equity, private debt, what does that mean?
Sure. So when you think of private equity or private debt or even private infrastructure, these are companies that are private or infrastructure assets that are owned privately. So they're not, trading like a stock on the stock exchange. They're not, no one has access to these types of investments or vehicles without being able, to utilize a private equity fund to gain that exposure. So
I've had the good fortune of having 6 different private equity groups back 3 of my companies, and they're basically making outsized return. They're targeting outsized returns, either in venture, which means startups, or private equity, which means larger established companies, where they'll take a position. You cannot buy and sell that stock until there is a liquidity event. And so it doesn't really price. So it might be sort of correlated, but you don't know because it doesn't price. It's kind of like your home. It's not actually priced every day. And therefore, you have longer term, typically not as liquid, right? You can't just, in most cases, I know there are some public alternative investment paths. Certainly gold is liquid. Bitcoin is liquid. But if most of these really good long-term investors, and they're firms like KKR and TH Lee, like big names, Carlyle, many of them are public now, Ares, who own both debt that is not public, so it doesn't trade on an exchange, and the stock of underlying, sometimes really large companies like Elon Musk's other venture, the rocket company. And so how do you invest in these things?
Yeah, absolutely. So there are different vehicles like KKR, for example, is a private equity manager, and they will build portfolios of individual private companies that, again, don't trade on a normal stock exchange. Perfect example, Joe, is SpaceX. So the average everyday investor, might know about SpaceX, wants to invest in SpaceX, but how do you get access? You get access through private equity funds where you're able to actually own a small part of that private company that otherwise you wouldn't be able to buy and sell
Got
on a
it.
traditional market exchange.
And obviously you get in by investing with, it feels like kind of like a mutual fund, right? You get
Right.
in because they have access, but you get their professional management. They're quite expensive,
Yep.
but you don't, also the sacrifice, Scott, is you don't get liquidity, right? And this is a great question that I have here. Hold on, let me find his name. Barry from Kennar, Louisiana. I don't know if I'm pronouncing that right. Excuse my Zimbabwean accent. But Scott, he asks, what is the role of an alternative investment in a portfolio? So you decide to put it in. When should you decide to do it? Is there an asset threshold? Obviously, the assets are illiquid. I know there's sometimes thresholds of you have to have at least $1 million or $5 million to invest. So where does it fit when somebody comes in and says, I want to own alternative investments? How do you think about their role in a portfolio and when somebody should invest in them or not?
It's a great question. I think that we start our process off, Alexa said probably the key word earlier, that's non-correlation. So let's bring it back into perspective for the broad conversation. What's happening out there? We've all been chasing these 7 stocks up for the last 7 or 8 years. They've performed magnificently, right? What a lot of people don't realize is those stocks make up a very, very large part of the U.S. equity indexes now. You own the S&P 500. I don't know, Lex, are they 30% now of the S&P 500?
Yeah.
Those 7 names. They've drugged the S&P 500 up. If they continue to perform badly and come down, they're going to drag the S&P 500 down. So what we look at Bleakley is how do we create portfolios where we're still participating in the market, but we create some non-correlation. What we want to do is on the edges, if that happens, we want to make sure we have something to offset those losses. So simply, you can buy non-US equities, which we always have. To Alexis's point earlier, they've been the dogs. They've underperformed the S&P so long. They're unloved. But now, they're trading at much lower multiples or much better value. And as we're seeing this rotation into value, into healthcare, et cetera, now you get out to alternatives. Now you're talking about private credit. You're talking about long short equity funds, infrastructure funds, again, that don't correlate. So what I think people want to do is take into account their liquidity needs. You don't want to own private equity or private credit for money you're going to need in the next 3 or 4 years, but for money you're going to need in the next 10 years, an excellent opportunity to get a good long-term return without correlating. So if those 7 stocks come down, you've got some protection from those stocks. Again, you've got your healthcare stocks, you've got your value stocks, you've got your public debt as well. So again, we're all about building a diversified portfolio. And what Alexis has done for our firm is find us really good ways to enter into these private equity, private credit, long short programs where you said before, Joe, they're expensive. There's been a lot of stuff out there developed for the retail market. It tends to be very
Retail
expensive.
market mean non-institutional
Retail investors.
people like you and me, normal humans.
Correct.
And
Who
I think
want access to the asset classes that they think rich people are getting into.
Uh-huh.
Wall Street's happy to create products for them. Unfortunately, historically, they've been products that are very expensive and they're not the same products. What Alexis has done for our firm and what we try to do is get as close as we can to those institutional type products for our clients. And we've been pretty successful doing that.
And so, Alexis, I think you can break these out into 3 unique areas, right? There's equity-like vehicles that are non-correlated, private equity, other kinds of long short strategies. There's fixed income vehicles like REITs, like REITs for simple terms, real estate, private debt. So debt that's more senior has a higher yield than traditional debt. And then there's true non-correlated, like macro strategies where you're shorting currencies and commodities, etc. when do you think, at what size levels? First of all, let me ask one question. There's accredited and qualified alternative investments. What's the difference?
Right. So accredited is typically you have to have $1 million of net worth or higher.
Of liquid assets, right?
Of
Like $1
liquid
million of investable assets. Yeah.
Exactly. And then goes all the way up to qualified purchasers, which is the highest tier where you have to have $5 million of net worth.
And that doesn't mean that you have to invest 5 million. It just means that it's a more complicated product. Therefore, you need to have at least $5 million verifiable, and then you can invest sometimes as little as 50,000 or something in some of these vehicles. You just need to have a certain level of threshold wealth to get in, right?
Exactly. And that's a great point, I think, that Scott had mentioned in terms of the access that has become available for everyday investors like all of us here. There has been a massive shift in this industry where there's really been a democratization of alternative investments where, all of these categories that we're speaking to have existed for decades, but they've only been reserved for the endowments, the pensions, the insurance companies, the largest institutions of the world. And there has been a massive shift where I think not only, do the KKRs of the world want our participation, but I think there's also been a shift at, the retail and wealth management level to think outside of the traditional 60-40 model, because it doesn't work the same way that it used to. Going back to the non-correlation piece, you don't have that same sort of protection in owning just fixed income and equities.
Well, look, I would say something else that is often ignored. There is a shadow economy that there's only one way to participate in. When you think about the Mag 7, all of them were hugely successful private companies before they went public.
Yep.
And it's happening even more now than ever. There is an entire trillions of dollars in wealth being created before the companies even go public, where they've grown 100x in value. Again, that happens rarely, but it happens. Some of them, of course, fail. That's why they have a portfolio of them. But so much wealth is being created right now, and these funds keep getting bigger and bigger, which means that they do what's called a sponsor-to-sponsor transaction. One private equity firm sells to another private equity, where they do another round at a higher price. And we're seeing it right now with Elon Musk's other ventures, like massive, almost $1 trillion valuations for companies that are not even investable yet for the public markets. By the time they come, they've already had this massive appreciation. They're already quite expensive. So I think that's the other thing, is the world has now gotten so much into alternative investments that you're missing out on a major asset class, and technology has allowed us all to get access in different ways. So that's really exciting. One last question, third question from Corey in Reno, Nevada. Used to gambling, obviously. The greatest little city. I know I went there for one of my daughter's volleyball tournaments. Couldn't stand the smoke everywhere, but it's a beautiful location. And he wants to know, what are the current trends? So what areas are most interesting right now in the alternative industry?
Yeah, I think for one, private credit, I'm sure you might have heard of, stories on the news and how big of an industry it's becoming. I think 30 trillion was the last data point that I read. But I think with where we are in terms of rates, rates being elevated, private credit gives you the ability to enhance income and take advantage of this elevated rate environment where some private credit firms are paying a 10% yield. And the way that works is SOFR, which is the overnight lending rate, plus an average spread or a premium of 5% or so, a little bit of leverage to help juice up the returns. But I think the other benefit with private credit that is interesting to people, just given the lack of visibility towards where rates are going, there's no duration risk there because it is floating rate, meaning it trends up and down with the mark rate.
So if rates go up, your payment will go up. It's kind of like a mortgage, I guess, an adjustable rate mortgage.
Exactly.
And obviously, these are companies where you have a more senior debt position. Hey, Scott, I want to wrap up this whole conversation on alts. Hopefully it's been helpful to people. Anything you'd add for anyone who wants to explore alternatives? How do they dabble their feet? Like, should they think about it? How should all advisors be talking about alternatives with their clients? Tell me a little bit about, just to wrap things up in a bow.
Yeah, I'd say that the answer to your second question is probably no. It's not appropriate for everyone, right? But depending on the size of your portfolio, depending on your time horizon, this is for long-term investors, and this is for typically people who have a large enough portfolio that the minimum requirement to invest in those isn't going to be too big of a piece, right? But I think that the way we look at it and the way I think people should look at it is private credit, for example, as you're looking at where we are in the equity market now, and maybe you are a little overexposed to equities. Maybe you've had this big run up, you're getting close to retirement. Private credit, if it's the right fund, and it has to be, gives you an alternative to maybe reduce that equity exposure a little bit. It's still long-term money, but at the end of the day, if you can get an 8 or 9% yield, which is a very much an equity type return without being exposed, so that if we do see a rotation and we do see this Mag 7, continue to degrade, you're now in an asset. There's a little more risk there, more liquidity risk than there is than market risk. But again, it gives you the opportunity to not go to cash like we started this conversation a half hour ago, but to get a real good return long term, but reduce that risk a little bit. So yeah, we look at, again, around the edges, where can I diversify this portfolio? Where can I create some non-correlation? And this is, alternatives are great. Non-US equities are helpful, moving from a little value to a little growth, a little healthcare, having some bonds in the portfolio. But yeah, we like using these alternative investments to kind of smooth it out a little bit, bring down that volatility a little bit.
And obviously, Scott, it's very important that if you are asking an advisor to do it, that they have a research team to select, because there's a lot of garbage out there. So the fact that you've got a dedicated person who heads that research and has a team of really smart people like Peter that we often have on the show is very important if you're going to be successful, because you can make a lot of mistakes and lose a lot of money if you're not selective. So let's shift. Thank you very much, team. That was super helpful. Let's shift to next week. I think everybody's looking at April 2nd, other than my wife, who's looking at April 3rd, which will be my 32nd wedding anniversary to the most amazing woman in the world. And so let's talk about April 2nd. That is the day that we've been told we're going to implement reciprocal tariffs to every country in the world. I don't know how in the world you'd get the mathematics done in that much at a time. I'm assuming AI is involved in some way, but Alexis, what should we think? Is this going to be a big nothing, or do you think it's actually going to happen? And what the heck happens if they actually stand up and say, yeah, we're now going to implement with all these countries these reciprocal tariffs?
Yeah, so I think who knows what's going to happen, but I do think that, there is a benefit to having certainty. The market hates uncertainty, and that is exactly what we've been experiencing this year. And that is what has been driving all of the volatility, where, companies can't make decisions because they don't know whether the tariffs are happening today or tomorrow, or if they're 20% or 10%. So I think regardless of what happens, having clarity, if we do get it, then will actually help, just reset and allow for whatever it is to be priced in, and for companies to be able to operate and move forward and adjust accordingly.
And as we've seen, there's hard tariffs, like a dollar amount percentage that you charge, and there's soft tariffs like, hey, we've got standards that you don't meet, which stops your products from coming in, right? So it can come in various flavors. So it'll be interesting to see what happens. I do think you're right. Some certainty will be good. It might be bad initially, but at least people will know how to price in, and it will re-stimulate the M&A and investment activities of corporate America that I think have really been dialed back, not knowing where the wind is blowing. We also have consumer confidence next week. I don't know if it's as important, Scott, but we have seen a little bit of dampening there. The early read is the confidence levels have been getting quite soft. Are you seeing it from your clients? Are people taking fewer vacations? Are they not buying that next home? Or have you seen, you've got thousands of folks that you serve at Bleakley. Have you seen any indication of people being a little bit more measured in their spending?
I think so, Joe. I think what we're seeing is, and it's early yet, but what we're really seeing it is in just the conversations with our clients. Maybe they're putting off the renovation they were thinking about doing. They're saying things like, I was gonna, I was gonna redo my bathroom. Let's wait till the second half of the year to see what happens. Or I was planning on buying a new car, but I think I'll wait 6 months. So, anecdotally, at the ground level, talking to our clients, we are seeing that. Again, it's been very volatile. People are a little nervous. They tend to pull back a little bit. I think if it continues, though, it could have an impact on the economy. Obviously, we're a consumer-driven economy. If people spend less, and they're more measured, then I think, it almost becomes kind of a self-fulfilling prophecy. But
Well, I can tell you, I experienced the first time I had to go to my daughter's volleyball tournament in Las Vegas this last weekend, and I stayed at the Fontainebleau for $130 on Sunday night. And
Right.
of course, there's the resort fees and everything else. I read a great article on the flight here today about the nickel and diming driving everyone crazy and stopping them from traveling as much as they used to. So we also have next week all kinds of inflation reports. Also, we get the durable goods report. So some economic data. Alexis, what do you think we'll see? Just more of the same, little bit of, it seems like the economy is not yet showing any signs of slowdown. Anticipation of a slowdown seems to be quite high.
Yeah, I think anticipation of a slowdown and fears of getting into this stagflation, which means, higher and elevated inflation and lower growth, is the fear. But it does seem under the hood that things are holding up, maybe even better than expected. So hopefully that remains the case, but we'll have to wait and see.
Guys, thank you. This was super educational. Scott, Alexis, wonderful debut. We know we'll have you back. For all of you watching, if you subscribe, when we do special edition shows, when there's high market volatility, you'll get notified right away. So it's worth subscribing. And if you'd like to get a review of your portfolio, please feel free to fill out the form. You get that for free. We do nothing with the information other than share it back with you, the team at Bleakley. And I'm very excited to have my partner in crime, Terry Carlson, here next week, because she's much better than me at this. So everyone, great to see you, and have a great weekend, everyone.
Thanks, Joe. Appreciate it.
Thank you.